Welcome back, everyone, to Money and Markets. Commodities, of course, have been the big story in the markets in 2010, but how will they perform in 2011, and how can you make money investing in them? Sean Brodrick is back on set with his outlook. He, of course, is the editor of the Crisis Profit Hunter newsletter. Also joining us on Skype from Bangkok, Thailand, is Larry Edelson, the editor of the Real Wealth Report for Weiss Research. And coming from Stowe, Vermont, is Olivier Garret, the Chief Executive Officer of Casey Research. Gentlemen, thank you all so much for joining us here today.
Thanks.
Olivier, I want to start with you. What is your overall outlook for commodities in 2011?
Well, at the Casey Research, we are very bullish with commodity in general. We think they are in the middle of a secular uptrend, and it's a long-term trend. It's based on the demographics in the developing world, and increasing middle class in India and China. In addition to this, the monetization of the economy, the responsible printing of money by the developed economies in both Europe and North America are driving a lot of commodity prices because of debasement.
Larry, your take on commodities?
Well, I agree definitely with Olivier. My view for 2011 is still very, very bullish. I'm expecting more quantitative easing or more money printing from the Federal Reserve and the European Central Bank. And we have very strong demographics and economic growth coming out of Asia that continues to push demand for natural resources and commodities much higher. We have to all remember that commodities remain in finite supply while fiat money is in infinite supply these days.
Sean?
Well, I think that we are looking at a really good 2011 for all kinds of commodities. Silver, gold, copper, oil. I mean, my targets on these things just keep getting higher and higher. China is, of course, the thing we always have to talk about. Just their demand for oil alone increased 29% in November over October. And then you look at their demand for copper, it's soaring. There is speculation in the market, which always makes it dangerous. There are speculators coming in, they're taking large positions, and they will want to sell those eventually. But if you're playing things for the long term, I think commodities are a great bet for 2011. You just have to wait for those dips, then you get in, and you'll have a really good year.
Let's turn to metals now, which is had just such an amazing bull run recently. Larry, you've done a lot of work, obviously, with the Foundation for the Study of Cycles. What is that telling you about gold, silver, and other metal prices as we move ahead here into the new year?
Well, my work with the Foundation for the Study of Cycles, remember, it includes data going back as far as 5,000 years in gold. And unequivocally, all the cycles point substantially higher for precious metals until at least 2016. Short term, however, on the shorter term cycles, I would not be surprised to see some kind of volatility and a pullback, but any pullback would be nothing more than a great buying opportunity because the cycles remain very, very bullish for the metals.
Olivier, what is your thought?
Yes, I couldn't agree more with Larry. We are very bullish in long term for commodities. We think it's very all indications is that the prices are going to continue to increase because of the demographics in the developing world. However, we do anticipate that there will be a pullback probably in 2011 due to the continuing financial crisis that is brewing in Europe and also with the states in the U.S. Having serious debt problems.
Sean?
Well, actually, they raised some interesting points, which it's kind of more time than we have time to deal with. But I would like to raise this point. All right, if things really go to hell, one thing people are going to do is they're going to have to sell their precious metals. We saw this in the last financial crisis because they make bad bets and everything else, and so they have to sell their good stuff, which is why they sold gold and why we had such a buying opportunity in gold and silver not that long ago. However, I don't think that's going to happen in 2011. Is the big crisis over? I don't know, but this phase of it seems to be over, and these things tend to be cyclical. And so we can have a waiting period before we see the next big eruption. Now, yes, Europe is papering over its problems. Absolutely, I agree with that. And sure, the U.S. states are in such a crisis, it's unbelievable. And yet, everybody seems to keep buying the line that, you know what, we can work this out. Until everybody realizes that the emperor is naked, you know, the agreement that he has no clothes, that he has a very nice set of clothes seems to be working. I don't think that it's going to all come crashing down in 2011. I think 2011, therefore, will be a good year, not only for gold and silver, but also things like copper and oil. Now, I can be wrong, absolutely, but that's just the way I'm playing it, and so far it's worked very well for my subscribers.
All right, let's move to energy now. What are your target prices for oil and natural gas prices moving ahead here to 2011? Olivier, let's start with you.
Again, in the long run, we are very, very bullish for energy. We do think there will be some pullbacks along the way as the financial crisis continues its course. But we think that in the end, in 2011, we'll see an increase in oil prices, probably around $100 a barrel. And natural gas is a little more difficult story because there's so much excess capacity in the shales in North America that we see the prices to move back and forth, but stay in the 4 to 5 range throughout the year.
Larry?
Well, long term, I'm very bullish on both. But in 2011, we'll probably see, even as early as January, $107 oil. Then I would expect a pullback to about $80 support level, at which point oil would be a fantastic buy again. And as far as natural gas goes, I pretty much agree with Olivier that it's going to be in a trading range between $4 and $5 a barrel for at least the first half of 2011. Then it should pop higher.
Sean, I feel like you're splitting the difference here.
Yeah, here's the thing. My target on oil for a while has been $105 in the first half of 2011. However, I expect it to get there. Everybody panics. You know, things go lower, people take profits. We'll probably keep hammering against that through the first 6 months of like 2011. As for natural gas, when I was at the Oil Council's Assembly of the Americas in New York, speaking to a lot of these oil and natural gas guys, they were so bearish on natural gas. There's a tremendous amount of production coming on from the shale all across North America. I don't expect much life there. Now, we have seen a rally in prices off some extreme lows, which if you were playing it for the short term, that kind of worked out for you. But I wouldn't make any long-term bets in there. The only way to play natural gas is through the pipelines because they make money even when the price is awful. So that's the only way I'd do it.
All right. Finally, let's get some specific recommendations here for investors looking to play the commodities market. Larry, what would you tell investors?
Well, I would tell them to be a little bit patient in here. We could see gold spike a little bit higher, but we're more likely to see a correction unfold in January, perhaps even lasting the first quarter of the year. I would use that pullback to buy blue chip mining shares like Newmont Mining, Gold Corp, and some of the higher beta gold miners like Yamana. And I would certainly look to add to those positions and accumulate for the long haul.
Olivier, what specific recommendations would you have?
For the investors that were heavy in commodities during last year and have benefited from a strong rise in prices, both in directly investing in commodities or in producers of commodities, we think it's very important that they don't forget to take profit, generate some cash, and be positioned to come back in during dips in early 2011. For those that are starting in commodity, are not invested, we think it's not a bad idea to start now. There will be lower entry price, so you don't want to rush into investing in commodities. But anytime there are dips, you want to be ready to deploy cash and invest in commodities and both major and junior producers of commodities.
And Sean, the final word to you.
I love having the final word on all this. I just have to say, this is great, but because I never get the last word.
Well, you're in the studio. It makes it easy.
All right. But here's the thing. Many people would say, well, you know what? This is about the time when you want to sell your gold and stuff. But we're seeing the demand shift because more and more Chinese demand is coming on, and that focuses around the Chinese New Year. So it depends on your time frame. I am expecting things to rally in the short term. You can play this now and probably make some good money, but the long-term picture is very good. Silver's probably going to at least $35, gold to $1,800, and those are some trends you can probably play.
Okay, Olivier Garret, Larry Edelson, and Sean Brodrick, thank you all so much. Happy New Year to all of you.
Thank you. It was a pleasure.
Thank you, Jamie.
Thank you, Jamie.
Also, thank you to Jen Amos, Rudy Martin, and Nilas Mativ. Now, this week, we took a look forward over the next 12 months. Next week, we're going to take a look back at the past year and discuss the trends that shaped the U.S. markets in 2010. What can they tell us about what the future holds? As always, if you have a question for any of this week's guests or a suggestion for a topic that you'd like us to cover, just email us at weissmoneynetwork@weissinc.com. I'm Jamie Holmes, and now, Martin Weiss.
I would like to add some words of caution. Right now, nearly all key decision makers in Washington, including some that you and I may have voted for, they're all killing the budget, and they're feasting on the spoils. The Republican leadership is getting the biggest prize of all, the extension of all the Bush-era tax cuts. But the White House is walking away with its own choice of morsels as well. It's getting the 13-month extension of unemployment benefits. It's getting a major cut in payroll taxes and more. Heck, even the rebellious Democrats are rebelling with a goal. They want to get a few leftovers of the spoils for themselves as well. So none of the key deal makers have assumed responsibility for our future or our children's future. And always, the underlying message seems to be the same. They say, yes, we know we're trashing the budget this year, but don't worry, we promise to fix it in future years. Well, history proves that such promises are emptier than a banker's heart. For example, back in 2008, the Congressional Budget Office estimated that the federal deficit for fiscal 2009 would be $438 billion. The actual deficit for 2009 was $1.4 trillion, over triple the estimate that they had made just 1 year prior. They made the same mistake for 2010 and for 2011, and today they're making that mistake again. Look, even while the President's bipartisan commission was testifying before Congress on the urgency of taking drastic steps to cut the deficit immediately, that same President and that same Congress were agreeing on equally drastic steps to enlarge the deficit also immediately. This is a very big danger hanging over our bond markets. So here's what I recommend. First, get out of long-term bonds of all shapes and colors. Government bonds, corporate bonds, municipal bonds, high-rated bonds or low-rated bonds. Second, although these higher yields on U.S. Treasuries could help support the U.S. dollar for a short while, don't expect that to last. When global investors sell, they sell both U.S. Treasuries and the U.S. dollar at the same time. Third, any decline in the dollar is bound to be closely correlated with rising trends in precious metals, agricultural commodities, and emerging markets. Just don't count on any of these markets going up in a straight line. Be sure to wait for corrections. This is Martin Weiss with Money and Markets.